Next up, we have treasury stock. And treasury stock are shares of a company's previously issued common stock, which the company has repurchased from the public. So at one point in time, these shares were issued, the public bought them up, maybe they traded them around amongst one another, and at some point in the future, the company has decided they want to buy back those shares from the public and hold them within the corporation's treasury. Well, why would a company do this? And the main reason is profit. No one knows about the company as well as the people running the corporation themselves, and they will know when they think the company is going to have a very prosperous period. They will know what's going to happen within the company during any given time. They will know when they think that a company's market value of its shares is understated, it's too low. And if that's the case, they have the option of buying back those shares from the public at a low price point, holding on to them for a while, and eventually flipping them, reselling them to the public at a higher price, therefore increasing their net assets. And while that is the main reason, it's not the only reason that companies buy back treasury stock. The market price of shares is determined by the law of supply and demand. Well, if a company buys back shares and puts them in treasury, they're no longer out in the public to be sold back and forth amongst shareholders, which means there'll be less supply. And when there's less supply and demand stays the same, prices go up. So a company can choose to buy back treasury shares to support or increase its stock price. Companies will also have options for their employees to be able to buy the company's shares at any one given time. And at times, the company will need those shares to satisfy those employee stock options. Yes, they could issue them out of authorized shares, but maybe they're out of authorized shares, or maybe they don't want to waste some of those authorized shares they have that are not issued yet. So instead of issuing new shares to the employees of that company, they will go and they will buy back shares from the public to satisfy those employee stock options by giving them shares which were previously issued that are now held in treasury. In journal entries, how do you account for the purchase of treasury stock? Well, treasury stock always goes on the books at its basis, as they call it, the price that you originally paid for it. So in this case, when we buy treasury shares, we're going to start by debiting treasury stock common. Why is it a debit? Well, treasury stock is a contra equity account. It is an account which is tied to all your equity accounts, in this case common stock, but actually decreases its value. Why would it decrease the value of common stock? Because shareholders no longer own these shares, the company has bought them back, therefore it's decreasing the amount of value in the company that your shareholders are entitled to. So we're going to start by debiting treasury stock common at the basis of the shares that we are buying. If on March 31st, Smart Touch Learning purchased 1,000 shares at $5 a piece, they would be spending $5,000 to acquire those shares in total. We would debit treasury stock common for that $5,000. And what would we have to hand to our now former shareholders to buy these shares back from them? Cash. So we decrease cash by crediting it for that same $5,000. The rule of thumb when you sell shares out of your treasury is you always take treasury stock off the books at the same cost basis that you put it on for. Well, that's quite easy if you're selling at the same cost. So if on the next day, on April 1st, Smart Touch Learning decided they were going to sell 100 shares of treasury stock, the first thing they would do is figure out how much cash they're going to receive. Well, they're selling 100 shares. They're selling them at cost, which was $5 a piece for them. It means they're going to get $500 in cash. So they would debit cash for $500, and they would credit treasury stock common, removing these shares from their books at the same per share price that they paid for it originally. Well, since they're selling at cost, that's going to be the same $5. $5 per share times 100 shares they are reselling means that $500 of their treasury stock is no longer going to be held in treasury because it's going to be back in the hands of the public. So what is the balance of their treasury stock common account at this point after they've made this sale on April 1st? Well, on March 31st, they bought back $5,000 worth of shares. They just sold $500 worth of shares, which means the balance right now is $4,500. That is the value to their cost basis in the common shares which they are holding in treasury at this time. Selling at cost is not ideal for companies. Their main motive in this is to make a profit. So hopefully when they resell these shares, they're going to sell above cost. Well, when you sell above cost, you're going to have to add a third account to your journal entry, which we'll get to in a second. But let's start with the amount of cash that they are going to receive. In this example, Smart Touch Learning is reselling 200 of its treasury shares and they're doing so for $6 a piece. Now, if you recall, a couple of slides ago, we bought them back at $5 per share, which means we are making a dollar per share profit. Well, if we're selling them at $6 a piece, and then we're selling 200 shares, that means we're going to get $1,200 total in cash for the sale of these shares, which were in our treasury before. So we start by debiting cash for $1,200. We need to take the treasury stock off the books at the same cost basis that we bought it back for. Well, we bought these shares back originally at $5 per share, which means those 200 shares that we bought at $5 a piece cost us $1,000 to repurchase. Since we put them on the books at a basis of $5 per share, we have to take them off the books at a basis of $5 per share. So we would credit treasury stock common for $1,000, the $5 per share cost basis, times 200 shares that we are reselling. And our debits wouldn't equal our credits if we just had those two. We need to have another credit for $200. Well, what is $200? Well, if we're selling these for $1,200 in total, we paid $1,000 to buy back these 200 shares a couple of days ago, we're making $200 in profit. And that's what goes into your paid in capital from treasury stock transactions account, which you are more than welcome to abbreviate to PIC Treasury, PIC-Treasury, because that's a lot of stuff to fit on one line. And you can always find that amount by figuring out what the profit per share is. In this case, since we're selling at 6 and we bought at 5, that's $1 per share, and multiplying it by the number of shares you're reselling, which is 200, returning $200 in profit. So we're going to credit PIC Treasury for that same amount. And after this transaction, the balance of our treasury stock common account would be down to $3,500. We had bought back $5,000, but we had resold $1,500 worth of treasury stock in total. And we would also have a credit balance to our paid in capital from treasury stock transactions account for $200, denoting the fact that we made $200 in profit from treasury stock transactions during the period. Now, sometimes things don't go your way. Companies will buy back their shares thinking that they're buying low, and their stock price will dip even lower. So in this case, on April 3rd, Smart Touch Learning is going to resell 200 shares, this time at $4.30 a share. Well, it's not great for Smart Touch because if you'll recall, we bought these shares back at $5 a piece. And if we bought them back at $5 a piece and we're selling them for $4.30, we are taking a 70-cent loss on each share that we are reselling. Well, the setup in terms of the accounts is exactly the same. The only difference is now we're going to have to put our PIC Treasury entry into this journal entry on a different side. But let's start with the amount of cash we're receiving. We are selling these shares at $4.30 a piece, and we're selling 200 shares. So if we get $4.30 per share for 200 shares, we'd be bringing in $860 in cash. So we debit cash for $860. We are taking a 70-cent per share loss on these 200 shares that we are selling. That's a $140 loss in total. And we are going to decrease our PIC Treasury account by that much. So we would debit PIC Treasury for $140 because PIC Treasury is an equity account, and like all equity accounts, it's going to go down on the debit side. And then lastly, we need to take this treasury stock off our books at the same per share cost basis that we acquired it at in the first place. And we bought these shares for $5 a piece, which means these 200 shares that we are now reselling at $4.30 a piece cost us $1,000 in total to buy back on March 31st. Well, since we put them on the books at a $5 per share cost basis, we have to take them off the books at a $5 per share cost basis. And we're going to do so by crediting treasury stock common for $1,000. And after this transaction, the balance of our treasury stock would be down to $2,500, and the balance of our paid in capital from treasury stock transactions account would be at $60. Why is it $60? Well, it's the total profit that we've made from treasury stock transactions during the period. In the last entry, we made a $200 profit. But in this entry, we took a $140 loss. So those offset one another, which means our total profitability from treasury stock transactions for the period is down to $60. To display treasury stock on the stockholders' equity section of a balance sheet, you simply subtract it, and usually list it as the very bottom item. So your stockholders' equity section would start with all the same information we've had throughout. You would list your preferred stock and all the necessary information about it, its par value, how many shares have been authorized, how many shares have been issued, and how many of those issued shares are still outstanding, as well as its balance. If there is a paid in capital in excess of par account associated with it, you would list it underneath. You would repeat those same steps for your common shares add up all the valuation from your preferred stock, your common stock, and their associated PIK accounts to find your total paid-in capital, one component of your stockholders' equity. Add to it your retained earnings, your other component of that stockholders' equity, and then subtract out your balance of your treasury stock accounts. And in this case, we're going to assume they had another transaction and they're down to 300 shares in treasury for a balance of $1,500. Well, you would subtract out that $1,500 balance. The only item that you're allowed to, that you should, I should say, list in the information is the amount of shares you have in treasury. In this case, they have 300 shares.